Hi, welcome to Inside the Hive. Today, I'm going to talk about the retail boom and bust cycles and lessons from the past 50 years. Retail real estate is a cycle. It's not random, and it's definitely not new. So over the past 50 years, we've seen retail boom, bust, evolve, and come back stronger every time. So in this video, I'm breaking down those cycles, what triggered them, what survived, and how you can use these patterns to invest smarter right now. If you stick around until the end, I will let you know what indicators matter right now and what to look for in this market and how to position yourself. Let's start by understanding the retail cycle. Let's set the foundation. Retail is economic, right? It's reactive, and you have to know what to watch for as far as the indicators are concerned. So let's start with what a retail cycle actually is. Retail follows the broader economy. Expansion, peak, decline, recovery. The issue is retail is definitely heavily tied to consumer confidence and their spending power. So as we see inflation rise, interest rates will spike, consumer spending will drop, and retail feels it fast. However, in this current economy, what we've seen this year, 2025, we're not as worried about the tariffs as many in relation to our tenants. We have a lot of food tenants that are typically buying a lot locally, and so they source a lot of their food and things locally, typically not as affected by this. If anything, their forecasting out this year has actually gone up. It's kind of cool to see. But the broader economy in retail, where you got during downturns, non-essential tenants definitely will close as discretionary spending slows. The essentials, thinking food, healthcare, your services, these tend to hold the line, and these are your defensive play when it comes to retail. So retail does react fast, both to the upside and the downside, and that's what makes it dangerous for some and incredibly profitable for others if you know the cycle. The boom cycle. What can we learn from past boom cycles? Let's look at how investor behavior and retail design evolved during the good times and how to spot any of these patterns that could be forming again. So let's look at the retail boom over the past 50 years. They all had one thing in common, and that was expansion. Let's take it back to the 1980s. The enclosed mall boom. Credit was cheap, developers overbuilt, and enclosed malls were the king. We had a little bit of a series on this, where these were anchored by big department stores, Macy's, Sears, JCPenney, and malls really became more of a lifestyle destination. This was a place that wasn't just a shopping destination, but somewhere you went, typically as a family, and you would spend hours there. The tenants were curated around this, but usually anchored by these big department stores that had great credit, helped Wall Street-backed REITs expand these malls rapidly because they really just kind of stamped them all over the country. And this era was really about scale and also experience, right? This was the destination experience. But the issue that you see now was many of these properties were not built for adaptability, and that's why they struggled later. Now, let's go into the early 2000s, where power centers and big boxes are the next big boom. Thinking Best Buy, Sports Authority, PetSmart, Target, Kohl's, where some of these tenants are still out there today, some not. Now, why these? Well, retail follows housing booms, and especially in suburban areas before the great financial crisis of 2008 and 2009, suburban America was expanding rapidly. And these power centers were filled with credit tenants. These are all backed by CMBS loans, which allowed developers good and long-term debt for these expansions and lending options because of these good credit tenants that they had in their centers. And so these were power centers stamped around the country where you could kind of go and see the same curated tenant mix in a lot of suburbs of the US, all outside of major cities there. So if you had a parking lot and an anchor tenant, you could build and lease it. It was really kind of a build it and they'll come. And everyone wanted in until they didn't. We move into the 2010s post-recession, post-global financial crisis bounce, where discounters and food anchors start to become the next boom. So after 2008, retail reemerged stronger, but it was definitely different. We had a lot of dollar stores, a lot of discount grocers. You had fast food, fast casual. That sector really caught a lot of wind, really had a big expansion over the last decade or 15 years or so. Retail leasing then really focused in back onto the essentials, value, repeat visits, not just the tenant's credit. This is where retail really began to shift again, in my opinion, from an overbuilt supply equation, which we saw early on post-World War II, all the way through the 70s and the 80s, into the 90s, where it was very supply driven. We're just following houses, they need retail, so we're going to put that there. After 2008, it really did a global reset, if you will. We went into a demand-driven retail again, back to the basics, demand. This was returned to core retail, affordable, repeatable, and resilient. It's the same playbook that we're actually seeing today. The question comes up a lot, are patterns forming again? And I'd say yes, but here's what to watch. So pattern number one is retail is following the housing growth again. Just like in the 1980s, in the early 2000s, retail development is tracking population shifts and rooftops. No secret about that. Booming markets like Phoenix, Nashville, the Inland Empire, Texas are seeing strip center demand in tandem with new home development. So retail follows rooftops. This is a foundational retail development rule that always comes back around. We're seeing it again. Wherever people are moving, neighborhood retail is needed. And that's why we're tracking rooftops and population shift just as closely as we track cap rates. Another pattern that we noticed is that national tenants are expanding, but so are the locals this time. So during past booms, national tenants and national chains really led the growth, Gap, Target, Starbucks. But today we see a multi-unit service-based expansion happening. Those type of concepts, dental groups, urgent cares, QSRs, brands, these guys are all back in expansion mode. We also see well-capitalized local operators growing as well. So especially in the fitness, med spa, food, and the pet care sectors. If it can feel like the early 2000s, you're not wrong, but it does have a twist. Instead of fashion anchors, it's dental chains, gyms, drive-through coffee type locations, and smart landlords. We are trying to curate these tenant mixes proactively. Another pattern that we have been noticing is rising construction costs and redevelopment over ground up. So just like in the early post-recession, post-global financial crisis, ground up retail has been rare, where land, entitlements, and costs are just too high for the ground up. Not saying they're not getting done, but it's a trend that we do see. And instead, investors are seeking underutilized strip centers to reposition, so buying existing assets, improving what is already there. This really does echo the 2000s bounce, where value really came from upgrading tired centers rather than building new ones. And that's exactly the playbook we're running today. Buy what's tired, but well located, and reposition it for the tenants of today. Another pattern that we notice is demand for need-based tenants, right? Every retail recovery focuses on essentials, food, fitness, education, personal care, and consumers are prioritizing services over stuff, just like they did post-2008 era. And these categories have low e-commerce disruption and typically high lease retention. So we saw after the Great Recession, we're seeing it again now. These tenants serve repeat needs. They're not impulse wants, but they are all back in demand. And finally, we see cap rates are drifting up. Does that equal an entry point for smart buyers? So in every past cycle, cap rates rose slightly during rate hikes, creating entry windows. So today, we actually are seeing retail centers that were trading 5 to 6 cap rate range in 2021, now trading somewhere high 6s, 7, 8 cap even. And this is the same pattern preceded massive investor returns and gains in the 2012 to 2015 window. So keep your eyes open. Seller buyer ask gap is definitely shrinking. So everyone wants to buy at the bottom, but few recognize when we're even getting close. So the last time cap rates ticked up like this, the best retail portfolios were built over the past decade. So yes, there are patterns to be recognized here. There are signs housing is expanding, need-based tenants are back in growth mode, and repositioning of tired assets is where the smart money is flowing. But if you understand what's already happening, you can see exactly where we are in the cycle and take action before the market even catches on. Next up, the bust cycles, where things went wrong, where every boom had a bust. Let's look at what triggered each collapse and talk about what went wrong and what we can learn from each bust. Rewind back to the late 80s into the early 90s, the savings and loan crisis, plus overbuilding. So we have too many malls and strip centers that were built, supply exceeding demand. So these were all supply driven, right? Land was cheaper, they could get good loans, credit tenants, you name it. It led to just oversupply where really there was no demand. We ultimately saw that. The savings and loan crisis really tightened up capital, halted construction, and many centers never were leased up and just abandoned early. So retail really is just a basic supply and demand equation. It isn't build it and they will come. It's a build it when it makes sense in a good location. And in the 80s, unfortunately, it just didn't. 2008 to 2010, the Great Recession. Retail credit froze, housing killed foot traffic, tenants failed fast, especially apparel, electronics, furniture type companies, and retail centers in over-leveraged suburban areas. They really suffered dearly. Now, this exposed the risk of overfinancing, and depending too heavy on debt-driven demand. More supply, money's cheap, so we're just going to build, not demand-driven. Fast forward into 2017, 2019, this is pre-COVID era. We're going to call this the retail apocalypse. Sears, Toys R Us, JCPenney, all collapse. Mall traffic really plummets here. Over-leveraged REITs get squeezed, and this is really misinterpreted by the retail, by the whole narrative of retail's dead. It was just all retail's gone, everything can be online. But as we're starting to see, and as we've seen over the last few years here, especially post-COVID, that retail is not dead. It was just bad retail was failing. Retail that wasn't adaptable. Retail that wasn't demand-driven. Retail in bad location. Retail with bad operators. These are the type of properties that are failing. No, it wasn't bad retail that died. Remember, it was outdated formats, weak anchors, zero adaptability, bad operators. So let's dive into what smart operators did to thrive. We're going to talk about a few real tactics and mindset shifts that work in both good and bad cycles. And here's what the best operators and investors did differently. Focused on resilient tenant categories, right? Not just focused on credit. They moved towards service-based tenants, which I can't say enough, essential, a little more e-commerce resistant, recession-proof on some level, medical, food, fitness-based tenants, less dependent on foot traffic from your anchors, and so more dependent on those essentials driving people to the center just because they need some of those items, and more focused on daily use behavior and necessity shopping, like I said. We also emphasized flexibility in leasing and space design with shorter lease terms, flexible expansion options, re-demise larger boxes into smaller, more modular suites that could fit multiple different tenants to attract them, maybe even putting in some of the infrastructure for food, grease interceptors, upgrading utilities, maybe heavier duty electrical, plumbing, things that could get it ready for a food operator, and then focus on the center's adaptability and new tenant types. Underwriting more conservatively, built in more of your downside cases, right? What happens if a tenant default? What happens if you've got vacancy? What happens if you've got a floating rate mortgage or something, or debt on this property? Really stress testing the models a little bit more, and again, focusing on that demand, and avoid over leveraging at peak valuations and structuring deals with more realistic rent growth and assumptions. There's no guarantee that, rent's going to boom 10% every year. That's just something I see on people's performance, and it's just absolutely not true. Fortunately, it has been like that a little bit, is not the norm. So you can't really underwrite to perfection in a cyclical asset class like this, but the best operators will underwrite for a dip. That way they can survive every cycle because of it. Okay, let's talk about what to watch out for now. And let's transition back in today's market so you can position yourself as someone ahead of the curve. Are we in a correction? Are we in a transformation? Is this just a pricing reset, or is this something shifting permanently to experience or convenience-based retail? I would say office and multifamily are facing structural issues. Retail, the right kind, is stable and in demand. So what indicators matter now? Watch for lending tightening or easing, retail vacancy rates, consumer spending and savings trends, and tenant expansions in necessity-based categories. How to position yourself for the next wave. The best buys, as you know, happen in the valleys and not at the peak. So we want to look for tired centers, but in a good location. We want to look for motivated sellers. We want a good story there. Is there a maturing loan? Is the seller aging and is just kind of let the property fall apart and not repositioned recently or remodeled or anything? The tenant quality is bad. You want to look for strip centers that need a significant amount of CapEx. That's something we really look for, where we can come in and do a major construction overhaul, really improve the look and the feel, the curb appeal of the center, and then tenant repositioning. Look at the tenant base. What does the tenant mix? Maybe it makes no sense. I'm sure there's a tenant or two in there that's doing well and the rest of them are just kind of in and out. So if you understand these cycles, you're really not scared of a downturn. We're waiting for it. And that's where the best retail deals come from. In summary here, retail investing is not about guessing. It's about pattern recognition. So these cycles will repeat themselves. History repeats itself. And the smart operators, we know how to ride them. And at West Ave Capital, we use these insights to find good deals that others overlook, and we turn them into cash flowing assets that stand the test of time. So if this helps you clarify what some of these cycles, past 50 years of retail have looked like, subscribe, and drop in the comments. We'd love to hear what cycle you think we're in, or what part of the cycle you think we're in right now. And I'd love to hear your take on that. Love to invest inside of us. Give us a call. Love to talk you through this. We focus on retail, neighborhood, revitalizing neighborhood retail. Follow us for more. Thank you so much.